Okay, let's start.
Hi, I'm Eva Ados, and this is Joel Schulman, the founder and CIO of Shares. Today, we're here for a new topic, private market access into a public liquid ETF. Why do you think people often misunderstand this new structure of having exposure to private equity inside a public vehicle such as an ETF?
Well, Ava, that's an interesting question. There are a lot of things behind it that people don't really understand. Even experienced investors in this space don't quite understand what an SPV is, which is the way that many people buy exposure to private assets. SPV is a special purpose vehicle. We can get into details regarding that. Also, there are issues regarding expenses, such as AFF&E, which is very confusing even to experts in the industry, including some media people who get these things wrong consistently. And then there are other things related to the liquidity aspects and illiquidity associated with these.
So what's interesting in general, though, and I want to start with the private equity market, and then I'll go to the public ETF. When two investors are in the same, let's say, company, right? A private market, a private company, it's the same name, same story, same excitement. And sometimes they have completely different outcomes based on the structure. So that is defined from the outset, from when you get into that specific equity.
Right. Well, you couldn't be more correct. I mean, the structure is really the key. And the structures vary depending on terms of what the economics are behind it. And so by that, I mean, is this something with expenses associated with it? Many SPVs, special purpose vehicles, which is the way many people buy into it. When investors buy into an SPV, they don't actually own the shares. They have interest in a vehicle which has the shares. And so they're one or two levels removed from the actual share ownership. They don't have voting rights. They don't have information rights. There are a lot of things, and they don't have liquidity rights that are obvious to outsiders. And so these SPVs, which is the way that many investors get into these things, are very unique. And the fee structures regarding the management fees up front and the carried interest, these things vary from vehicle to vehicle.
Well, this year has drawn a lot of attention recently. We see many questions about inflows, outflows, concentration coming up and down. And so I wanted to ask, because there's so much questions, there's a lot of misinterpretation in the market. What is the main reason why there's a lot of misinterpretation and a lot of questions? And sometimes that comes also from very educated financial experts.
Okay, well, let's talk about a few things. First of all, as you know better than most, our XOVR ETF was the first ETF to get into private equity exposure within an ETF wrapper. Now, the importance of an ETF wrapper, which is an exchange-traded fund, and these things trade throughout the day, so they have daily liquidity. And 85% or more of our particular ETF is in large cap public equities, which have a VC lens, which I know you would like to talk about a little bit more. But we have our own proprietary index. It's the Entrepreneur 30 Total Return Index. And this is a long-term track record. And this long-term track record, the index, provides the bulk of the assets in our particular XOVR ETF. And then we have traditionally 10 to 15%, sometimes more based on various market dynamics, but 10 to 15% private equity exposure. The largest of which right now is SpaceX. We could talk about that, but it's in what is called an SPV vehicle, which a lot of people don't really quite understand.
Okay, so before we move on, I just want to make clear this is a podcast that is for educational purposes only. This is not investment advice, and people should consult with their financial advisor.
Absolutely.
Okay, let's get into it.
Okay.
Let's start with a macro picture.
Right.
Why has this become an issue at all? Why are we even having this discussion about providing private equity exposure to the everyday, to the retail investor? Why is this such a hot topic lately?
Well, so traditionally, as you well know, over the last 30, 40 years, the dynamics have changed. 30, 40 years ago, back in the 1980s, 1990s, or even early 2000s, companies would come to public sooner in the marketplace. Now companies are delaying it for a variety of reasons, but let's talk about this. When some of the The classic examples, take Amazon or Nvidia. When they went public, they were less than $1 billion market cap. And then, of course, today, they're trillions of dollars of market cap. These are the exceptions to the rule. This is not the norm. But what was very typical back then is companies coming to market, going public. So when you hear going public, it means an IPO, initial public offering. And they would do so much earlier. Now, companies are delaying going public for a variety of reasons. We could talk about this in greater detail.
So what would you say are the biggest reasons why a company nowadays might choose to stay private for longer?
All right, great question. A lot of reasons. One, there's access to more private equity now. VCs, sovereign funds. There's a lot of equity, a lot of private equity on the sidelines, institutional investors. And what's important for the folks back home to understand is that the dynamic of getting into companies early on in their growth cycle has changed fundamentally in the last 30, 40 years. If you were getting into a $1 billion market cap company that later, and again, this is an exception to the rule, but later became like an Amazon or a Meta or a Microsoft or whatever, or an Nvidia, and they grew to trillions of dollars, this is a multiple rate of return that a lot of retail investors can get years ago. Nowadays, that has shifted quite a bit because now companies are delaying going public. They might be $5 billion, $10 billion, $20 billion. In the case of SpaceX, it may be over $1 trillion of market cap. And all the return that was made previously were to institutional and accredited investors. So the retail investor was locked out. And that's why I think it was you who coined the expression democratizing retail access to private equity. Okay. And that is what was the purpose behind XOVR.
Yes. And as an aside, I think we should note that the median time of a company going from a venture round, the first venture round, to an actual IPO has tripled in the last 2 decades. So that's a substantial amount of time. And then again, all this growth, all this value creation is staying behind before the IPO. And then most of the retail investors, the investors that are not accredited in many cases, are not able to access it. And that was the primary reason why we came up with this new innovative ETF structure that includes exposure to private equity.
Right. Now, importantly, not every private equity company has these extraordinary rates of return. So to be clear, the Anthropics, the Andurils, the OpenAIs, the SpaceX, these are the exceptions to the rule. And, many private companies never have the opportunity to go public. But the all-stars, the big winners are the ones that we're focusing on nowadays. And what we're trying to do is get those late-stage companies just before they go public. Our dream scenario is we get companies just before they go public, put them into our ETF wrapper, which allows daily liquidity and mark-to-market, each day on the public sleeve, and allow investors to share in some pre-IPO returns. That's the goal of the XOVR ETF wrapper, but recognizing that the bulk of the returns are still principally in the 85+% normally in the public sleeve.
Let's move into SPV mechanics. And SPV stands for Special Purpose Vehicle. It's a legal entity, and would like to hear you speak about it, how the mechanics work, and what investors should know about it. Because there's a lot of misunderstanding, again, when it comes to SPVs, and many people don't even know what an SPV is.
Right. So as you point out, SPVs, a Special Purpose Vehicle, there are ranges of these things. The structure really matters. The economics behind it matter a lot in terms of there's information rights, which generally don't accrue to the investor. There's transfer rights, which can go on, as you know, 15+ pages just in transfer rights alone, the restrictions. There's voting rights. Investors don't have voting rights. And so there are a lot of restrictions on the SPV vehicles. And again, the SPVs may own shares in the underlying vehicle, but the investors don't own the shares. It's in the SPV. So the investors own, and they own a stake. They own a percentage of an SPV, which may own shares. So the investor's twice removed from the shares. They don't own the shares. They own an investment in a vehicle which owns the shares.
That's interesting. So if an investor says, I own SpaceX through an SPV, is that imprecise?
It is imprecise. They own exposure to an interest in it. Now, presumably, they'll get benefit when the value goes up or they'll lose value and the investment goes down, right? So there's a correlation to that. Sometimes the correlation is lagged in some, private markets. So, for example, public markets will move much faster than a private market. A public market, because it's being priced daily. So, for example, in late 2025 and 2026, there are concerns with AI. Public assets move very quickly, and many of the more risky securities went down.
Yes.
During early 2026, there are concerns about the war in Iran. Okay, the public securities can go down. The private securities generally are not moving very often.
No, correct.
So there's a lag time between the public markets and the private markets.
Walk us through the right differences, because I think a lot of the small print is important here. It matters enormously.
So we talked beforehand about voting rights. Investors in SPVs don't have them.
Correct.
They don't have the informational rights. They're not entitled to the financials. That usually goes only at best to the owners of the vehicle. They don't have, they have transfer restrictions. And so there are a lot of restrictions related to it. So it's not the same as owning public stock. Importantly, probably the biggest difference is the expenses related to these vehicles. Oftentimes they come with management fees and carried interest.
Yes.
So management fee might be 0%, 1%, 2%. And you may have carried interest, which could be 0. It could be 5, 10, 20%. So if an investor is in something with 2 and 20, it means they're paying a 2% management fee and a 20% carried interest. So when someone has a 0, that means they have no management fee and no carried interest. The value of that particular SPV is higher than something with, let's say, a 220.
Yes.
And so the various ranges of price that you pay for an SPV, you'll pay the highest for something that has low management fees, low carry, and you'll pay less for something with high management fees and high carry. And this difference is important. And also the liquidity of these vehicles will vary. So it's easier to sell something with very low management fees or no management fees, no carried interest, than something with high management fees and high carried interest. So that structure is really important. Not everybody understands it.
Yeah, and we've seen SPV agreements run 60 to 100 pages long. Do investors read that, or should they?
They absolutely should reread these things. These are very complex instruments. And what people sometimes don't realize, when you're buying exposure in a security, or when you're buying exposure to an interest in a company, it's not like going to CVS or Walmart and buying a bottle of water. I mean, these are very complex transactions. It's going through a number of parties. They're a very labor-intensive process. And if you see interest in companies that are anticipating going public, for example, if there's rumors that they may be going public, the demand will be very high. We've seen this firsthand with, our SpaceX exposure.
Yes.
Demand is very high, and investors who have it don't want to sell it because they want to get the potential IPO. And the supply is very small. So in order to get that vehicle, investors are going to have to pay higher to get that. And if they want a 0, they're going to pay more yet.
What are the fee components when it comes to SPV? Because there's a lot of misunderstanding, again, when it comes to SPV fees.
Okay, now you may be referring to, in addition to the management fees or carried interest, you may be referring to the AFFE. And these are fund acquisition expenses. Okay, now we had those when we had to buy our SpaceX position. And it was a one-time expense. We made that clear. Some media experts got it correct, which we're grateful for, and some got it wrong. And they consistently got it wrong. And we tried to correct them, and they still got it wrong. Okay.
Do you think that's a broader issue in the market, that investors, because this is a new structure, trying to figure out how it works?
Yes.
And again, it's our job here as the pioneers of this structure to educate.
Correct.
Through videos like this or press releases that we've sent out.
Correct. So the AFFE, we put out 2 press releases trying to explain it in detail. We put out amendments to our prospectus trying to explain in detail. We've been in various media broadcasts trying to explain these in detail. Again, some media experts continue to get it wrong, and we're trying to explain that. An AFFE expense is a necessary expense in some cases to acquire. It's an acquisition cost. So if you get into a security which is in high demand, you oftentimes will have to pay additional fees to get into it, depending on the structure of that vehicle. And it's generally associated to be a one-time cost of acquisition. Now, in our particular case, we made this clear, we paid money, we paid funds to acquire a position in our particular SpaceX exposure. We made that clear. We mentioned there was a non-recurring expense. That does not mean there will never be other expenses down the road, okay, because there may be new positions we get down the road, whether it's in a SpaceX, we add more to that position. We're not right now, but we very much like our convictions position in it. But down the road, maybe we get more Anduril,
yes,
we have a small position Anduril, or maybe we buy some Anthropic or OpenAI, and we may have to pay those expenses down the road. But
there will be a one-time expense by transaction
potentially for future, for future positions. But we're not going to have additional AFFE for the 205 million we currently have in our books.
When it comes to valuation, because that connects directly to the SPV structure, when it comes to valuation in the public market, we all know that's easily tracked.
Right.
But in the private markets, it's different.
So that's one of the reasons why we also wanted to have our structure to be as transparent as we can get it. And it's better for the investors to have something which is going to be marked to market as quickly as possible and in a transparent vehicle. And so by having something which is effectively a 0-0, that means it'll be much easier for us to price it in accordance with public announcements, which usually correspond with tender announcements, or if there's a potential IPO or something of the sort, we can market more quickly. When something has a fee associated with it, and this is one of the problems with some of the SPV vehicles, the auditors have to evaluate that position, say, what's the true value? They have to hire experts to assess the true value of it. It takes longer to mark that to what is perceived to be the current market price. And so because funds want to be conservative with and accurate in disclosure, it's going to take a little more time. And so when we recently had our transparency reset, it was with the sole purpose so that we can mark our positions faster in a more accurate setting for the benefit of the shareholders. And that's why we called it a transparency reset.
Let's move to a practical question.
Okay.
If I wanted to sell this position today, not at the mark, but at a negotiated transaction, what would I receive?
Are you talking about the SPV
Yes.
position? Okay. Now, it depends on which position you're looking at. So, for example, if there's a range of liquidity within this so-called illiquid category.
Yes.
So a private equity instrument, which let's say has a market cap of $1 trillion or $1.25 trillion or higher, is probably going to be much more liquid than something which is like 30 million in market cap. And so there's a range of liquidity within the private equity space. And moreover, it also depends on the market timing, right? So if we have a war in Iran, that's going to be different than if we have a strong bull market and interest rates are declining, right? So the appetite of assets varies with the market. The particular security, depending on what industry or sector it's in, varies by the market. The market, if it's a higher market cap and there's demand, or in the case of some of our securities, if they're anticipating a future IPO, that's probably going to have much greater liquidity than something which may be a decade or two down the road and may have cash flow problems and so forth and has a harder time raising capital. So there's a range of liquidity within the market. Now, what's very clear is you don't list the security and sell it, within 10 minutes. Okay?
Yeah.
But, the liquidity by nature says, how quickly could I sell something and get fair market value? That's the definition of liquidity. You could always sell something at cash. A lot of times people say how long it takes to get cash. You can sell even a house quickly and get cash. You may not get fair market value. That's the important thing.
That's right.
Getting fair market value. If something's in high demand, if there's and there's some secondary pricing, which we're not going to speculate what the secondary pricing is, but there are various sources that are selling these things in the secondary market. And if it's clear that the secondary prices are above, certain levels of book, there should be some comfort that if a company needed to get rid of that position, they could do so.
Is it fair to say that one of the lessons learned is that no investor should purchase a private asset with capital he or she may need in the next 2 to 3 years?
Correct. No question about it. If you have capital in your, let's say, in your senior years and you're living off this and paying rent and so forth, you should not be in a position to buy large stakes in something that's illiquid, right? Because you may not be able to get the cash when you need it or want it. And so people who buy private equity, and by the way, to be clear, the people who buy private equity or exposure to private equity, generally speaking, in the marketplace, are accredited investors, which means they have certain net worth, levels, right? So not every retail investor can have access to private equity. In fact, most can't, by definition. So the person who's buying private equity, by definition, already is a high net worth person with over $1 million plus in net worth, and they have certain income levels as well. So there's certain levels of investors who can buy these things. But even among those people, if you're a high net worth or an accredited investor and you're spending $1 million or $2 million on private equity, that's not money that you should be expecting to live off of the next couple of years.
Yes, and we're trying to change this, offering the retail investor who might not be accredited to have daily liquidity when he or she wants to access exposure to a private company. So let's move to our next subject, my favorite, ETF wrappers with private assets or exposure to private assets.
Correct. So let's think about this. Sometimes, and again, some so-called media experts, I'm referring to so-called, because they often get it wrong. They're talking about bid-ask spread differentials and problems with getting liquidity, sometimes with private equity exposure, and that's inaccurate, right? What's important for people to know, for example, in our particular ETF, it usually trades a bid and ask is a price between what you buy and sell. And so if it's within a penny or 2 pennies or 3 pennies, that's generally considered to be pretty liquid. If it's trading 10 cents off or 15 cents off between the price you buy and the price you sell, it's considered less liquid.
Definitely.
Right? So in our particular case, because we have generally 85% or more, generally 85% or more, that's the intent, in these U.S. large cap public equities, they go back to our Entrepreneur 30 Total Return Index. They're very liquid. So that means the ETF is relatively liquid and the price differential between what you buy and what you sell is pretty narrow, even though our private equity exposure doesn't trade and show price differentials each day. And that's important for people to know, that our private equity sleeve doesn't change the price very often, but the ETF itself is very liquid and it trades what's considered net asset value or NAV. It trades very close to that.
Okay. There are structures where the private exposure is held inside vehicles that might have zero management fee and zero carried interest. How does that work?
Well, that's what we have right now, where we've effectively paid the price so that the vehicle going forward is not going to charge our investors or to us, which we then pass through to our investors, the management fee and the carry. And that's a very attractive feature to have in a vehicle. What we get is our management fee per year. We charge what we earn for our ETF is 75 basis points per year, which is less than 1%. It's 0.75%. So no matter how much the SPVs may cost or whatever, that's not a fee that we get for our fund. And that's important for people to know, that we're not profiting on this. In fact, we're doing this additional work because we feel very strongly about putting private equity exposure in ETF wrapper for the benefit of our shareholders.
And we never increased our management fee, even though we added the private equity sleeve. So that's interesting. Now let's talk about daily liquidity in this context, because this phrase is widely misunderstood.
Okay, so the daily liquidity corresponds to two things. One, you have the ETF wrapper itself, okay? And the ETF trades very close to NAV throughout the day. It's got a 1 or 2 cent spread differential between the bid and the ask, the price that you buy, the price that you sell. And that's what's important for investors to know. So irrespective of the private equity exposure in our ETF, the ETF itself is trading throughout the day very close to its what's considered its net asset value.
Mm-hmm. So when investors redeem, the first thing that's sold is the most, what we call public, the most liquid, right?
Right.
So how does that work? Explain that asymmetry, because many investors have questions.
Yeah, a lot of investors are concerned, will I be able to get my money out? What if the private equity sleeve doesn't trade?
Mm-hmm.
So we have, again, the bulk of our assets are in these highly liquid U.S. large cap equities that are trading actively through the day. So we've got positions in things like Meta and Robinhood and IBKR and Palantir and so forth. And these securities are trading throughout the day, billions of dollars of volume. And that's the majority of our assets. It's in our index, which is the Entrepreneur 30 Total Return Index, which has a long history. And that's what provides the liquidity. So investors can come in and out throughout the day and every day.
So the illiquid piece shrinks mechanically inside the ETF.
So the dilution effects are very important. And this is another piece that's misunderstood. So in December and January, we had very large inflows. We went from $400 million to about $1.8 billion, $1.8 billion in about a week. Okay?
Yeah, that was 7 to 10 trades.
7 to 10 trades, that's right. It was not thousands of trades. It was basically 7 to 10 institutional investor trades, maybe arbitrageurs, we're not sure. And they came in for a period of time. They were trying to take advantage. We're not exactly sure why they came in, but we assume that they came in for a short period of time, and then they left. They left in a short period of time as well. And so when investors come in and they add AUM, assets under management, the percentage of the private equity exposure, which is remaining fixed, it moves in discrete jumps. It goes up or down in discrete jumps. And so what happened was that that exposure shrunk as a percentage of assets under management simply because the assets rose, but this little private equity exposure did not move. Similarly, when we increased our private equity exposure and brought it from 33 million to 205 million exposure, then that became a fairly solid weight. And then when the assets left, the 205 million remained constant, but then it increased in percentage, just simply on dilution. Didn't mean that there's any mismanagement or misrepresentation. Simply meant that as a percentage of assets under management, the percentage went up. It went down first, and then it went up.
Some investors might say that if an asset doesn't trade daily, it shouldn't be included in a daily traded portfolio or vehicle.
Okay, well, this is a topic, one of the topics of today. We believe that assets, private equity exposure, is an important asset for retail investors to have access to, in some manner. They currently have access to it in some open-end funds. They have it in closed-end funds. They have it in the interval funds. It's less common in ETFs. We were the first ones to do it. Now there's another fund that has it, but it's a new innovation in an ETF wrapper.
We've also seen traditional mutual funds hold equities in emerging markets or very small cap equities or even high yield bonds, right? So there is already illiquid assets within mutual funds or ETFs or closed-end funds, interval funds.
Well, this is a very important point, a very important distinction you're making. So, for example, ETFs have long held different exposures to assets that were less liquid. For example, the most liquid investments would be something that's a Mag 7, a Meta, a Microsoft, a Apple, a Google. These are very, very, very liquid investments. They have market caps of trillions of dollars, but there are public vehicles in emerging markets which are extremely illiquid. And so there's a range of liquidity from very liquid, which is going to be, something in the Mag 7, Magnificent 7, to very, somewhat illiquid, which might be in emerging markets or frontier markets. small cap or nano cap. So there are different levels, market cap structures, and nano cap would be under 50 or 100 million. And then you have micro caps, which are up to 250 million, small caps, which may be up to a couple billion, mid caps up to 5 billion plus, or 5 to 10 billion, and then large cap generally at 10 billion and more. And then you have the mega caps, which are generally 100 billion or more. So depending on the market cap size, depending on what exchange is on, U.S. exchanges, NASDAQ, and NYSE are more liquid than other exchanges. But it depends on the exchange and the market cap size and the number of investors and the float, which is another thing, how much is available in the market to trade on a daily basis. So this float is also very important.
That's right. And I want to touch on the public equity piece, or what we call the public sleeve of our portfolio, because that's where most of the day-to-day performance comes from.
Correct. So 85+% of our fund is in this Entrepreneur 30 Total Return Index, the ER30TR. And this index drives the bulk of the performance. So in good markets, we have a long history of this and a very compelling history. But in strong markets, it does better than average. And in weak markets, it does worse than average. So it moves with the markets, but on an accentuated basis. So as the markets go up, which they did in 25, through October, the end of October, they went up, particularly their biggest stretch was between April and October. They went up quite a bit, about 50% for the fund and 60% for the index. And between October 23rd and February 23rd, or October 27th to February 23rd, it dropped, quite a bit. So it moves very much with the market, and it generally moves stronger than, for example, the some of the better known indices, indices like the QQQs, because we do not have heavy concentrations or any weight in things like Apple or Microsoft or Amazon. We don't own anything in those. We have a partial weight in Google. We don't have a full weight in Tesla. Meta, we own a piece. In NVIDIA, we don't have. Even though NVIDIA, we invested back in 2005, we've shifted our assets to other areas too, because we have this private equity sleeve now.
And how has the ER30 TR index performed over the last 20 years? Because we have a track record over that time period.
Well, so the index has performed very strongly for most of that period. However, in periods of retraction, like we saw, 2008 or 9, 2021, 22, just recently in 25, for the last couple of months, during those periods, it underperforms the market. So for that index, it's important to recognize over the long history, and generally when it spikes up and then takes a dive, or it declines, when it spikes up and then declines sharply, investors should look at that and realize, it suffered over that period of time, but over a long period of time, it generally does well.
How would you say it has performed compared to popular indices such as the Russell 1000 Growth?
Over the 20 years, it's performed very well. It's dominated those over 20 years. But then in short periods, isolated periods, it's going to underperform. And that's really important to look at the long history. So for any index or any fund, any stock, you can see for short periods of time, it will either significantly outperform or underperform. And that's why in our industry, as you know, it's always important to have the caveat, past performance is not necessarily a guide, or it's not a guide for future performance. That's true for good times and bad times as well.
Yes.
So if something significantly outperforms, you can't assume it's going to continue to outperform. If something underperforms, you should not assume it's going to continue to underperform.
Okay, so, but the thesis behind the ER30 TR index, and again, this is an index that's based on your research over 20 years at Babson and Harvard, where you studied entrepreneurs and VCs, venture capital investors, and how they invest and how they allocate capital and what they study when it comes to a company. They look at the culture, they look at the leadership team, how the founder behaves, and the research and development, the innovation, the competitive advantages, if the company has a moat, how flexible it is to change in a changing environment. That's particularly important today with AI. And so I wanted to say this to people that, which is interesting, that we did try to democratize access to private equity, but I think we should share with people what gave us this idea that we have this so-called entrepreneur factor, which is based on your model. And that's how we come up with the year 30 TR index. We have a very big universe of about 65,000 publicly traded companies. And then we filter them with the entrepreneur factor, which is comprised by 18 attributes, both qualitative and quantitative. And so after you filter that universe, you come up with many what we call entrepreneurial companies, and then we choose what we deem as the most entrepreneurial. And the 30 most entrepreneurial comprise the year 30 TR index. But I think it's important to tell people that when we bring this VC lens to the public market, and again, all the FANGs were in the year 30 TR index from very early on. We were in NVIDIA when it was a $5 stock, when they were creating cameras, for backup cameras for the cars. And so it's interesting, I think, for people to know that what triggered the idea of the XOVR private public crossover ETF was that we added large cap private companies into our universe, and we run our entrepreneur factor. And what we saw was that SpaceX ranks very, very high. And then we're like, okay, so that could be the Magnificent Eight. It could be the new Magnificent. In fact, we believe it will be the best Magnificent. And so that was what triggered us. And then if SpaceX stays private for longer, just like as we discussed earlier, many companies stay private for longer, then why would we not access all that growth, all that value creation before it goes public? That's what triggered this whole new ETF wrapper that we came up with.
I couldn't agree more behind the comment that SpaceX is a great company. And in fact, out of the more than 60,000 public and private companies, maybe even if you include the private companies, it's hundreds of thousands. But
yes,
of the investable universe, if we had to pick one company right now that we really had strong conviction on,
yes,
I cannot imagine a better company to invest in right now with our strongest position than SpaceX.
yes.
And I know you believe very
Yes.
strongly about the moat. I want to hear a little bit more about why you think the moat is so
First
strong.
of all, I believe, and I think you too, that Elon Musk is the greatest entrepreneur of all time. So aside of that, though, when it comes to SpaceX, it has a real moat, and it's very hard for most companies to compete with it. And it's not just space, because SpaceX is very vertically diversified, right? It's space, but it's also telecom. And when it comes to telecom with Starlink, they compete with the most bureaucratic companies. So it's quite impossible, and I can't use this term, but it's very difficult for a bureaucrat, what we call a bureaucratic company, such as the telecom companies, to compete with a very, very entrepreneurial company led with such a great entrepreneurial leader, such as Elon Musk. And so it's going to be very hard, and it has an actual moat, and it's not a low-hanging fruit. When it comes to AI, and there's so many glamorous companies now that we love too, but we don't like OpenAI and Anthropic, etc. But there's not a real moat. There's so many companies doing very similar things. They're great. They offer amazing value, but it's not clear to us who is going to be the leader. When it comes to SpaceX, we have very strong conviction that it's going to be the winner, and that's why it's the top weight, the number one weight in our XOVR portfolio.
So this conviction behind SpaceX with the founder that you mentioned, Elon Musk, one of the things a lot of people don't know is that a few weeks ago, Elon Musk had a net worth that was more than some of the other Mag 7s in the group. Sergey Brin from Google, Mark Zuckerberg from Meta, Jeff Bezos from Amazon, and Jensen Huang from NVIDIA. He had, a few weeks ago, more net worth than those four combined, plus $6 billion. And what a lot of people don't know also, they know him, the Tesla founder, obviously. 3-4 years ago, Tesla was the primary source of his wealth. Is probably 2/3 or so. And today it's inverted. Now it's mostly SpaceX. And so SpaceX is clearly going to be the growth engine for him going forward. And we couldn't be more delighted to have that. And you mentioned this point about going up against the telecom companies. Traditionally, when an entrepreneur goes against bureaucrats, as we refer to those telecom companies, the entrepreneur wins in big way.
Mm-hmm. Let's go back to the structure, right? So we mentioned we have a private sleeve and we have a public sleeve. How does the repricing work between the two, and how do we have both together in the same ETF wrapper?
So the publics reprice daily throughout the day. They're trading actively, particularly since we have 30 large cap public companies. They're trading very actively, very close to net asset value throughout the day. And the private position trades periodically with tender announcements and so forth. So it doesn't change that often, but that doesn't mean the NAV of the fund is thrown off, because it has a step-up function or step-down depending on valuation. But the publics are trading all the time. And when people get creations or redemptions, it's based on the liquidity of our public asset basket.
Should investors expect to trail that pure index in the short term, with the expectation that the deferred performance of the private sleeve will catch up and then some in the future?
Okay, that's a good question. So we've got to recognize a couple of things. One, when the public markets are rising, and we're looking at the index, which comprises 85+% normally of the ETF, and the public markets are rising, the index will outperform the XOVR ETF simply because the private sleeve is not moving very quickly. It's not moving very often. And so when it's repriced over a period of time, the expectation is the private position will at least perform as well as a public position if it's at a strong weight. But generally, the index will precede the performance of the ETF when the markets are rising. The corollary is also true. So, for example, in February, March of 2026, the public markets were declining because the war in Iran, and so what we saw was that the ETF had effectively what was considered a cash drag. The privates did not move. They're a fairly significant weight in the fund. And so as a result, the public positions went down, but the private position did not move. And so as a result, the ETF outperformed the index. So it really depends on the movement of the public markets. During periods where public markets are performing well, the index will outperform the ETF, irrespective of the movement on the private sleeve. When the private sleeve moves, it presumably will catch up and then some. But if it's not moving, then the public markets will outperform the ETF, and the corollary is true. When the markets are declining, the public markets will drop, and the ETF, based on the immovable position in the private market in the short term, will not move. Therefore, that weight will mitigate any downward movement.
Let's move on to a case study. When it comes to SpaceX, and we should have a disclaimer here that SpaceX, as of today, is still a private company and has not filed for an IPO. So when it comes to SpaceX, can you give us an example of how that would work within the ETF if and when SpaceX would go public?
Okay, so again, this is rumor at this point. There's no truth necessarily behind this, but it's rumored. So a few months ago, let's back up a little bit. A few months ago, they came out with a valuation in the neighborhood of $1 trillion. And this is a tender offer. And then they combined it with XAI for $250 billion more.
Yes.
So the combined company now rests at about $1.25 trillion. There are rumors that say the company wants to go public at $1.75 trillion. Now, if that's true, and the rumors initially were that they're going to start the S1 process, the preliminary process to go public in March, with the hopes of maybe going public as recently as soon as June. Now, we're almost as of the time of this taping, we're almost at the end of March, so that hasn't yet happened. And so, who knows what's going to happen, when it might file, and when they may go public. So we don't know that. there are inflationary concerns right now in the market. There's a war with Iran. So we don't know what's going to happen in 2026, to be clear. However, if SpaceX goes public and they go public at 1.75 trillion, which these are all rumors, we don't know if they're true, but if that happens, it will be one of the biggest, if not the biggest, IPO in the history of the markets. Now, what's interesting about this, there are a few things that are to know. Many investors in these SPVs, these special purpose vehicles, are locked up for a period of time. Usually the lockups are 6 months. Maybe this will be shorter, maybe it'll be longer. But there's generally a lockup, which means investors in these vehicles are unable to sell. Now, in the ETF, our investors can buy and sell every day. They can sell and buy multiple times through the day. So they don't, we as the owners of the SPV may have that issue, but the investors in the ETF don't have it.
No liquidity issue.
Investors do not have that liquidity issue in an ETF. Now, what's important to know about companies after they go public, and we've looked at, I'm an academic, right? So as an academic, I like to look at these things. I like to study them. And I went back 10 to 15 years for high-profile public companies that went public. They were large cap, over 10 billion. They were in the similar space. So we had a short list of companies. We had about 15 or so. We had companies like Facebook, now Meta. We had Alibaba. We had Snowflake. We had Airbnb. We had Rivian, Palantir. We had a number of these companies. And then we go back. Last year, we had CoreWeave and Circle.
Yeah.
Now, what the studies show is that in the first 6 months, they actually go up from IPO up on average about 130%. That's quite a pop. And I'm going to come to that in a moment. It's not universal. Nobody's making any promises. Nobody's saying this is what's going to happen. They tend to go up. Okay. Not always, but many. And this is 15. I'm not going to make statistical statements on the likelihood of anything going public. So be clear, I'm not suggesting that that's going to happen to SpaceX. Again, this is an educational discussion. I'm a professor, so I'm speaking basically as a professor now. Take a small sample size, they tend to go up. But what's clear, there's discussion of the S&P 500 index committee saying that they may allow early entry for SpaceX into their index. Now, that's significant to investors in this particular company. If it does go public, and if the S&P 500 allows entry of SpaceX onto their index early, that's a very potentially a very significant variable, because there's about $7 to $10 trillion in ETF and mutual fund mandates behind the S&P 500 index, and there's maybe another $7 to $10 trillion of mandates in institutional funds following the S&P 500. So that means there's maybe $15 to $20 trillion following the S&P 500 mandate index. Now, if that's true, and the data indicates that it's somewhere between 15 to $20 trillion of mandates, and the S&P allows SpaceX in the index early rather than, not maybe immediately, but within a short period of time. That means if SpaceX comes out with the same valuation as, let's say, Tesla, which is right now about $1.5 trillion, SpaceX is expected, if they go public, to come to market at $1.5 trillion or higher, potentially. They're saying 175 right now. That means there will be about 2% of the S&P 500 potentially following this stock. Now, they may make it based on float. They may make it overall. But theoretically, 2% of the S&P 500 mandate would be 300 or 400 billion they'll follow. If the company comes out with a $50 billion float initially, depending on how the index committee decides to rule on SpaceX and what percentage they put based on they may do it on the float, they may do it on the overall market cap. That could be very significant for this particular position. We're not saying that it's going to go up. We're not saying it's going to be part of the S&P 500. But the fact that the S&P 500 Index Committee is thinking of putting it in, we think could potentially be very significant for investors in this particular stock.
Yeah, let's speak about that because this is the one scenario where all three types of investors that we spoke about today come together. You have the ETF investor, you have the SPV holder, and then you have the post-IPO investor. So how would that scenario work for each of them?
The index, so the investor in an ETF wrapper has flexibility to buy and sell his or her shares whenever they want. They can ride it up and down, depending on the market movements. The SPV holder,
So they have daily liquidity
Yeah,
even on the
daily-
day of the IPO.
anytime they want. They can get out the day of the IPO. They can get out a month later, 3 months later. They can hold it forever. They have the choice. The SPV holder has to hold it for whatever the lockup period is, whether usually 6 months, maybe it's longer, maybe shorter, we don't know. So the goal would be ideally to try to get into it before it goes public. And that's, as you know, the rationale behind our XOVR ETF to provide retail investors access before it goes public, right?
What should investors know when it comes to liquidity in the various scenario analysis about XOVR?
So with XOVR now, we have a strong conviction position in this private equity exposure, which is SpaceX, right? And we couldn't be happier with that. We believe SpaceX is the greatest public or private company on the planet right now. That's our conviction. That's our belief. And we're very happy to have this for our investors. We would argue, first of all, that in terms of liquidity, that's not been an issue and we don't anticipate. The bulk of the assets are in highly liquid U.S. large cap public equities. If investors want out, they can get out. If they want to buy in, they can buy in. Now, when it comes to various scenario analyses, some analysts, media analysts, talk about different scenarios. What if we had to sell SpaceX? Will we sell for at a loss? We wouldn't, in our opinion. We wouldn't, because there's demand right now. And what's interesting about some of these analysts, when this media analyst says about different scenarios and criticizes the fund, this one particular analyst ignored the most likely scenario, which is
SpaceX goes public.
What happens if SpaceX goes public? We have a conviction allocation to this one asset, which if it goes public, and we hope it does, and if it goes public, that's going to be beneficial for the investors. And what we find really interesting is this one analyst who's had criticisms ignores not only an important scenario, but perhaps the most likely scenario. And we believe that having a conviction allocation to SpaceX exposure is a good thing for our investors, and our board agrees.
But people like to frame their analysis in any sort of particular way, so they can choose the scenarios they show. Okay, let's move to the next subject. What we've learned. So we were the first ETF that provided access to private equity to the retail investor, right? We pioneered this structure, and we have, as we were the first and we were the innovators, there was no structure when we started. We had to create a structure. So what we've learned along the way and how have we repositioned things inside XOVR to become more and more efficient. And again, we've been working with great experts out there, so we're very grateful for this.
Okay, so to your point, when you're the first, what we've done is we've continued to improve transparency. And with that, we're in vehicles that will report more timely, more accurately. We are clear in terms of how to provide liquidity for our investors and how to position into assets. We've expanded our outreach to the private equity community. And so we've done a lot of things in the last year and a half since we started, which will continue to move things forward for the benefit of the investor. And that's really what we're trying to do here, is expand the market for the benefit of the investor. And we see many more great opportunities, going forward. We believe that SpaceX will be our certainly our first position in it. We're hopeful that it will go public, and when it does, we expect it to be a member of our index for potentially a very long period of time, and then we'll position to other private equities down the road, which will be hopefully the next SpaceX opportunity.
Mm-hmm. Thank you, Joel. That was a very interesting discussion, I believe. We hope we touched on many of your questions. We spoke about the private sleeve, the public sleeve, as well as the mechanics, the AFFE fee, the liquidity when it comes to XOVR. We hope we answered many of your questions that we've received via email, and we hope that was an interesting discussion. Don't forget, the reason why XOVR was created is to democratize access to private equity companies such as SpaceX. Thank you for joining us.
Okay, thank you.